after the price of silver literally got its teeth knocked in, China recorded its largest single monthly inflow of silver and is importing more silver than ever in recorded history after the price got destroyed. And I believe it's a Brinks facility in Hong Kong. There is something called exchange for physical where, these players could buy a contract in the West to exchange for physical in Hong Kong, take possession there, have it driven to the Shanghai Metals Exchange. I'm not talking to the guys at Goldman Sachs and JP Morgan about this, but I can certainly tell you that when you look at the open interest, that being the number of contracts every single month versus the amount of deliverable metal, it's what could possibly go wrong territory. The CME group is really a bunch of big players, very big players that you would think would protect their own before that happened. I don't know, could 4 glitches since Thanksgiving have anything to do with trying to offset this arithmetic?
If enough people stood for delivery, at the same time, it would be, in essence, sort of a run on the bank, and there wouldn't be enough physical to actually meet that, and then all of a sudden the system would seize.
In first day notice for April deliveries showed that 10,138 gold contracts stood for delivery. That's 1,013,800 ounces of gold. And 1,181 silver contracts, that's 5,905,000 ounces of silver were posted for delivery. And, if we look back at the March numbers, Adam, we see there were 14,559 gold contracts delivered, which obviously a lot of gold, 1,455,900 ounces. And 9,212 silver contracts, 46,060,000 ounces. This is the question that, in my mind, has been missed completely and totally by the mainstream. These are not trivial numbers. You're in the billions and billions and billions of dollars every single month, a lot of it leaving COMEX. A week ago, Friday, I believe we saw 2 million ounces leave the eligible category. Those aren't even for sale. Those aren't even bars that are posted. That would be like someone taking 2 million ounces out of our storage program in 1,000-ounce bars, which is an eligible category, Brinks JFK, New York, and taking physical possession of them. So, how much does 2 million ounces weigh? I mean, I'll ballpark it for you. You're looking at, ballpark, uh, about 168,000 pounds. So, when you realize that in February we talked about almost 39 million ounces leaving the COMEX, getting on trucks and going, that's over 2 million pounds. So, yeah, it's continuing unabated.
Billions are quietly leaving the system, yet prices barely react, and that disconnect should raise eyebrows. As Andy Schectman points out here, over 10,000 gold contracts and nearly 600,000 ounces of silver stood for delivery, while millions of ounces are physically exiting COMEX, including 39 million ounces in February alone. That's not speculative churn. That's inventory depletion, and markets historically reprice when supply tightens. Yet price action remains muted, suggesting either suppression or delayed recognition. For investors, this gap between physical flow and pricing signals hidden stress building underneath. Next, Andy Schectman discusses why price may be the biggest distraction in this entire setup.
You look at what happened for not just here too, because you look at what happened in February after the price of silver literally got its teeth knocked in. China recorded its largest single monthly inflow of silver ever in recorded history. January and February combined were off the charts. February was the biggest single month ever. Now, this is from the second largest producer of silver in the world, who's been flying all around Latin America for the last couple of years, buying doré and concentrate from Mexico and Peru, number 1 and 3. So the number 2 producer in the world buys doré and concentrate at double what the West will pay from 1 and 3, and then is importing more silver than ever in recorded history after the price got destroyed. Price is a tool of misdirection, is the moral of the story. The price will throw you off the trail. The price will throw the media and the talking heads off the trail. And the financial advisors, you're crazy, Mr. Jones. Why would you ever buy that stuff? Look at how poorly it's performed in this atmosphere. But then the money over there says, shh, and they're scooping it up like this while everyone else is being misdirected by price. That is the kind of stuff that to me is all you really need to know. If you have the ability to separate reality from emotion and say, yeah, really? If price was that big of a hindrance, then why do we see entities across the globe doing what they're doing to accumulate it? And for going on 18 months here in the United States, billions every single month. Doesn't all leave COMEX, but a lot is. And to me, that's really all you need to know about where this is ultimately going.
Okay. And again, as you're saying, I mean, this is, what is it, thousands and thousands of tons of metal. I know I've asked you this before, but when you think about, okay, well, who can take that size and ship it and store it? And I believe you come pretty quickly to the opinion that
Hmm.
it's probably sovereign actors. Like this is largely probably going into some sort of government vault stored somewhere, right? Someplace big enough to hold all this.
Well, Occam's razor would say you're probably right.
Okay. So let me ask you this. So obviously that could be the US doing that, taking it from COMEX and adding it to the government's stores.
When prices fall but the biggest buyers accelerate, the market is signaling something most investors are missing. As Andy Schectman points out here, China recorded its largest ever silver inflows right after prices collapsed, while aggressively sourcing supply from top producers like Mexico and Peru at premiums above Western bids. That behavior contradicts the narrative that weak price equals weak demand. Instead, it suggests strategic accumulation during engineered weakness. For investors, this raises a key question. Are prices reflecting value or masking it? Smart money appears to be front-running a longer-term supply squeeze. Next, Andy Schectman unravels how this metal could be quietly moving across global channels.
And I think you
Yeah.
believe that's probably part of what's going on. Let me ask you this. Do we have any safeguards? You talk about how China has been buying so aggressively and openly here. Could some of this stuff be coming out of COMEX and then just be putting on a cargo plane and being sent to other foreign parties like China? Or do we have safeguards against that?
Well, the short answer is yeah, it absolutely
Okay.
could.
So the COMEX will sell and deliver to anybody, basically.
Yes, and but one of the provisions of the strategic metal designation is that, like the critical mineral list, is that they can limit or curtail exports. That would be silver and platinum in terms of the precious metals. But yeah, absolutely they can, and I think that does happen a lot. And there is a contract on COMEX as well that is in Hong Kong. I believe it's a Brinks facility in Hong Kong. And there is something called exchange for physical, where these players could buy a contract in the West to exchange for physical in Hong Kong and take possession there, have it driven to the Shanghai Metals Exchange by armored cars. So yeah, absolutely, there could be.
The idea that physical metals can quietly leave Western exchanges without restriction is a risk few portfolios account for. As Andy Schectman points out here, COMEX effectively delivers to anyone, and mechanisms like exchange for physical allow contracts bought in the West to be settled and collected in places like Hong Kong. That means supply isn't just shrinking. It may be shifting geographically towards stronger hands. Historically, capital flows follow strategic priorities, not price signals, and this looks increasingly policy-driven. For investors, that raises geopolitical risk around access and pricing power. Next, Andy Schectman discusses whether any real safeguards exist to stop this drain.
Now, we don't know how much of that is, and I would think if it was a constant delivery drain down, you would start to see things happening that would seem out of the ordinary, much like we continue to see on COMEX these days. But yeah, the answer is yes. And I don't know what safeguards are there if it started to get out of control, but my guess is this administration might have a problem with it, at least is my opinion.
Okay. Well, Andy, one of the reasons why I love talking to you is because you are so down in the plumbing of this industry, and you get to see sort of all the flows that are occurring. This, um, trend of delivery has now been continuing for a good while at this scale, unprecedented scale, and
Yeah.
use your words. Are you hearing anybody in the ecosystem yet starting to raise concerns about inventory tightness? Like, hey, we're not gonna be able to do this forever. At some point, somebody, the LBMA, COMEX, or whatever, so somebody's gonna start getting tight on actual physical. Are you
Well,
hearing that at all? Is that a concern at all yet?
if numbers could speak, if arithmetic could speak, then yes. I mean, you're not really, I'm not talking to the guys at Goldman Sachs and JP Morgan about this, but I can certainly tell you that when you look at the open interest, that being the number of contracts every single month versus the amount of deliverable metal, yeah, it's, what could possibly go wrong territory. Um, you're seeing that here. You're seeing that in London. The amount of contracts that have been issued against the amount of metal that could be delivered is ridiculously out of whack. And so, in that respect, yes. What is different, Adam, is that no one has ever experienced delivery like this. This is an anomaly in every sense of the word, where most contracts my entire career, 99% or better, never stood for delivery. That is changing. And that's why you've never really, I think, had to deal with something like this. No one ever had the incentive to do this. No one would challenge the West or our markets, that the Achilles heel of this entire system.
When contracts far exceed deliverable metal, the system isn't just stretched, it's mathematically exposed. As Andy Schectman points out here, open interest is now wildly out of proportion to actual physical supply, both in COMEX and London, something historically masked because over 99% of contracts never stood for delivery. That behavior is now shifting, and even a small percentage demanding delivery can destabilize the entire structure. This isn't theoretical risk, it's arithmetic pressure building inside a leveraged system. For investors, that means price signals may lag until a sudden repricing event forces alignment. Next, Andy Schectman unravels why this imbalance has never been stress tested before.
There are two. One is that it can be delivered, where contracts typically were used to offset risk for producers and farmers and miners and manufacturers and companies like mine. You offset the risk with your inventory. So if the price drops, your inventory doesn't drag you underwater. But now that little Achilles heel that says, well, you can take delivery if you want, is now being exploited. And the second one is that they can exploit the paper price, sell paper in the United States, which is the only market that settles price or
Mhm.
creates or defines price, and then buy it elsewhere around the world with less fanfare, with less public acknowledgement, with less media attention. So yeah, there's no question about that. And conventional wisdom says, well, they always get open interest down into the delivery month. It's always happened before. Um, okay, so why do you need insurance? Your house is never burnt down. It's like we're getting to that point now.
What used to be a safety valve in the system is now becoming its biggest vulnerability. As Andy Schectman points out here, delivery mechanisms designed for hedging are now being actively exploited, while paper selling in the US sets global prices that buyers quietly arbitrage elsewhere. That creates a structural imbalance where price discovery is detached from physical demand, something markets historically correct, often violently. Investors should recognize this isn't normal cycle behavior, it's a shift in how the system is being used. When it's always worked before becomes the logic, that's usually when it breaks. Next, Andy Schectman discusses strange signals emerging from inside the system itself.
The only other thing is the CME group is really a bunch of big players, very big players that you would think would protect their own before that happened. But, I don't know, could four glitches since Thanksgiving have anything to do with trying to offset this arithmetic where twice on the upside there's a glitch or an overheating, and then twice on the downside it's ironic that the circuit breakers glitched. So yes, these are all of these things taken together are worth more cumulatively in my mind, Adam, than they are in and of themselves, because it's a pattern of nonsense. One of these days that nonsense will catch up with I think the trustworthiness of an institution that goes to these kind of lengths um, to destroy price discovery. It's happening, and little by little by little. Then when's that coming? I'm not sure.
Right, right. Well, so not unlike the banking system, which kind of works on trust, um, it's all fine and dandy, and it can largely be manipulated in either any direction. But at the end of the day, you can't argue with physical ounces, right? They're either there or they aren't, and it's not that dissimilar. And I'm not trying to be hyperbolic or say this is indeed what's going on, but I'd love your thoughts. It's not the potential is not that dissimilar on a run on the bank, right? Where you can have a bank that's fine, but if enough people show up and say, "I want my money right now," all of a sudden your healthy bank becomes unhealthy. Um, is there the potential that we're sort of starting to see a run on the physical bank in these exchanges? And it hasn't gotten to criticality yet, but it could. In other words, if enough people stood for delivery at the same time, it would be, in essence, sort of a run on the bank, and there wouldn't be enough physical to actually meet that. And then all of a sudden, the system would seize.
When market glitches start aligning with pressure points, it stops looking random and starts looking structural. As Andy Schectman points out here, multiple circuit breaker issues since late November hint at stress inside a system trying to balance paper exposure against shrinking physical supply. Historically, financial systems break not from one event, but from repeated small anomalies that erode trust, just like early signals before the 2008 liquidity freeze. For investors, the key risk isn't volatility, it's a sudden loss of confidence, triggering a rush for delivery. That's when liquidity disappears fastest. Next, Andy Schectman unravels whether this resembles a modern-day bank run scenario.
Yeah, that is exactly what it is. It's also ironically happening in similar scale at the exact same time in the private credit market, where again, it all boils down to trust, lack of trust, trust of our institutions, trust of our markets, trust of our political structure, trust of everything. And yes, that is exactly what is happening. That's why people tell you there is no um, really there's having physical possession. It eliminates the counterparty risk that is growingly pervasive in everything these days in markets where you know old rules don't really apply as much as they were. And all of these things, whether it be a run on COMEX or a run on the banks, are reminiscent of one thing, a Ponzi scheme. A Ponzi scheme where you issue more paper than there are um, bars
Right.
or
More,
shares
more,
of a
more claims
certificate.
than actual
Yes,
collateral.
yes,
Yeah.
and that's exactly what it is across the board. Or you leverage yourself too much in private equity and sell it based upon liquidity that when everyone comes at once, it doesn't matter what market you're talking about, if it's over leveraged or over or rehypothecated, when everyone comes at once, you have a problem.
When multiple markets show the same stress pattern at once, it's rarely coincidence. It's systemic. As Andy Schectman points out here, the parallels between COMEX and private credit markets highlight a shared vulnerability. Too much paper layered over limited real assets. That's classic leverage risk, where everything works until too many participants demand redemption simultaneously. Investors saw similar cracks during March 2023 banking stress, where confidence, not fundamentals, drove outcomes. The shift toward physical ownership signals, rising distrust in counterparties, not just a preference change, and when trust erodes, repricing happens quickly. Next, Andy Schectman discusses how macro conditions could accelerate this dynamic.
Let's all hope that this war is over swiftly from here. If it is, I'm curious what you think the reaction of the precious metals will be. I can certainly make an argument that some of the things that have been suppressing them during this time, like countries having to sell their gold to fund the high oil prices, if oil prices do come down after the war ends, you could make an argument that that will return a bid to gold. But don't let me put words in your mouth. What are you expecting?
Well, that would be the conventional wisdom because then, oh, they're going to lower rates again, is what they would say. So that's so friendly for gold. It's so nonsensical to me, Adam, because it's a convenient omission for them to say, well, gold went up parabolically in the face of the strongest interest rate increase in history, right? They forget about when rates were rising, gold was doing well. What this is in essence Gibson's paradox, which speaks to the inverse relationship between real interest rates and gold.
The narrative that gold only rises when rates fall ignores what actually happened in recent cycles. As Andy Schectman points out here, gold surged even during one of the most aggressive rate hiking periods in modern history, contradicting the textbook interpretation of Gibson's paradox. That suggests other forces, like currency debasement, geopolitical risk, and central bank demand, are now outweighing traditional rate correlations. Investors relying solely on Fed policy signals may be missing the bigger macro shift underway. When old relationships stop holding, it often signals a regime change in markets. Next, Andy Schectman unravels why trust may matter more than interest rates going forward.
That is the underlying theory there. And it's nonsense because I think one thing that Gibson's paradox needs to take into account is trust. Again, back to trust. If
Hmm.
the United States were truly trusted globally and there was organic demand for the US Treasury and everyone wanted to be here, well, yeah, then that's true. A high interest rate that says, let's say 7% yield on the Treasury. That's strong, right? Well, that says the rule of 70 seconds. The mathematical law says you take 7 into 72. In 10.2 years, your investment would double. Okay, so that would be great if the dollar in the United States was revered and trusted. But when money creation and inflation is running much higher than that, the dollar lost over 10% last year in the dollar index, you would actually be negative real return. But that's besides the point. My point is simply this, that does it really matter to the people accumulating gold that interest rates go from 4 to 5%? Maybe to some it does. To the talking heads, it does. It doesn't matter for most people accumulating gold because their reasons.
A 7% yield sounds powerful until inflation quietly erases the real return behind the scenes. As Andy Schectman points out here, the rule of 72 suggests money doubles in about 10 years at that rate, but that math breaks down when the dollar itself loses over 10% in purchasing power in a single year. That exposes a deeper issue. Trust in the currency, not just interest rates, is what drives real demand. Investors focusing only on nominal yields may be ignoring negative real returns, a pattern seen during past inflationary cycles. Next, Andy Schectman unravels why this disconnect between data and reality could reshape investor behavior.
Are far past what 1 or 2% interest rate to a dollar that is losing far more than that each year is worth. And the dilemma for the people reporting on this is that the statistics that they use to measure things like the CPI um, mask the reality. So you have to be able to separate yourself from, I think, the way things always were and the system that is built to hide and mask an inflationary agenda. And then take a step back further and say, could we really be nearing the end of and the dominance that this what the United States empire? And again, I don't mean to be such a buzzkill this morning and sound as though it's over, but there is a fine line between realism and pessimism. And I thank God every day I live in this country and I am a patriot and I love this country, but we are nearing the end. It's all about mathematics and it's about trust. And both of them aren't looking good right now. So to me, a slight uptick in interest rates in that environment is nothing. Bring us back to 1989 and say that environment, and I'd say, yeah, that's pretty substantial. Who's going to want gold if rates keep rising in this country where everyone wants to be here and be invested here and yada yada yada? Not so much right now.
Official inflation data may look stable, but the lived reality for investors tells a different story. As Andy Schectman points out here, metrics like CPI can understate actual monetary debasement, creating a false sense of stability while purchasing power erodes faster beneath the surface. That gap between reported data and real-world impact is where long-term wealth quietly gets diluted. Historically, when trust in economic reporting weakens, capital shifts toward hard assets and alternative stores of value. For investors, this isn't about pessimism. It's about recalibrating expectations in a changing system.